This is another very substantial hit for people with mortgages. Those on variable rate mortgages will see them going up by between 25 and 30 quid a month per £100,000 of outstanding mortgage. And of course, then you have the huge bill shock that's going to come for anybody coming off a cheap fixed rate, and the price is going to go up.
Following an unexpected event, the UK is dealing with a sudden mortgage crisis, leaving many homeowners in a state of distress. With the security of finances shaken, there's an urgent atmosphere calling for quick action from the government. The once strong support for owning a home now feels unstable, putting the country's economic stability at risk. As families and individuals confront the looming threat of financial insecurity, a call for help is sounding in the government, urging immediate action to prevent a big problem. The situation in the UK is tough, with over 1 million households expected to run out of money by the end of the year, showing how serious the property market crash is. The pressure on people's mortgages is even worse than it was during the mortgage crisis in the 80s and 90s, affecting everyone, including people who rent and people who own property. The average family that has to pay for their home spends about 33% of their take-home pay, which is much more than the average of 17% according to the ONS. Many people will find it hard to manage their finances with the upcoming increase in mortgage payments. In the UK, the problem is that mortgage and rent payments are taking up a big chunk of people's budgets, rising from 33% to 55%, which is quite extreme. The average family is struggling to make ends meet, spending 112% of their budget on basic needs, leaving very little for extra expenses. In September, the Bank of England kept interest rates at 5.25%, following 14 consecutive increases since December of 2021, when the bank rate was only 0.1%. This decision came after some good news from the Office for National Statistics, showing that inflation dropped to 6.7% in August from 6.8% in July and 7.9% in June. However, inflation stayed the same at 6.7% in September, which might lead the Bank of England to raise interest rates more to try to control inflation when it announced its decision on November 2nd. People looking for a new mortgage will hope that this next decision from the Bank of England means that the time of lots of interest rate increases is finally over. Mortgage prices shot up about a year ago after former Prime Minister Liz Truss's mini budget, which made the market uncertain and caused the value of the pound to drop a lot. This made mortgage lenders quickly take their deals off the market and then bring them back at much higher prices. Even though mortgage prices went down a bit during the spring of 2023, many lenders started raising their prices again as the bank rate kept going up because of high inflation. Even though inflation has been going down, the cost of fixed-rate mortgages has been getting lower since it reached its highest point. According to better.co.uk, the average cost of a 2-year fixed-rate deal for all types of borrowers is 5.7% right now, and 3-year deals are averaging 5.6%. The average cost of a 5-year fixed-rate deal is 5.26% at the moment. The average cost of a 2-year tracker rate mortgage right now is 5.71%, with the best deal of this kind being priced at 5.39%. Better says that a typical standard variable rate from a lender is 7.95%, which is a lot higher than the 4.78% it was in July of last year. According to MoneyFacts, there were 5,495 residential mortgage deals available as of October 1st, more than the 5,338 in September and the 5,056 in August, showing that lenders are starting to offer more deals in a calmer market. When the bank rate goes up or down, it affects how much people pay for their mortgages. UK Finance, a trade body, thinks that there are about 1.4 million homeowners who have mortgages with variable rates, like base rate trackers. These people have seen their monthly payments go up right away every time the bank rate goes up. For example, if the average tracker rate goes up from 6% to 6.25%, Someone with a £200,000 loan taken out over 25 years would have to pay an extra £30 a month, making their monthly payment go from £1,289 to $1,319. People who have fixed-rate mortgages where the interest rate stays the same for, let's say, 2 or 5 years, don't have to worry about changes to the bank rate. But when their deal ends, which will happen for about 800,000 people in the rest of 2023 and another 1.6 million in 2024, the new deals they can get will be more expensive. The most recent big house price reports show that UK property values have gone down the most in over 10 years. Halifax's report from October 6 says that in September, the average house prices went down by 4.7% compared to the year before, which is the biggest drop since 2009. But the monthly drop at 0.4% was a lot less than the 1.8% in August, which might mean that the fall is slowing down. According to Halifax, the average cost of a house in the UK in September was £278,601. Nationwide's report from October 2nd said that prices went down by 5.3% in the 12 months up to September, the fastest fall since 2009. Every month, prices didn't change, so the average UK home cost £257,808. In autumn 2022, the government raised the amount of the property's price so that you don't have to pay stamp duty from £125,000 to £250,000. The bank tries to slow down the economy and control rising prices by raising interest rates. Inflation, measured by the Consumer Prices Index, CPI, was at 6.7% in September, lower than the peak of 11.1% in October of 2022. However, the government's target for the Bank of England is only 2%. Governor Andrew Bailey emphasizes the need to bring inflation back to normal. Rising energy costs have been a key factor behind high inflation, but they are starting to decrease. The energy price cap, set by Ofgem, was £2,074 since July, but has now been reduced to £1,923 as of the 1st of October. While this is the first time it's been below £2,000 since September 2022, it's still nearly 50% higher than the £1,277 in March of the same year. In the second quarter of this year, the buy-to-let property market in Britain reached a critical point. According to Seville's recent research, buying a home with a typical loan-to-value ratio, meaning a deposit of 30% or less, and renting it out is no longer profitable. Mortgage rates have pushed the returns on a new buy-to-let property into negative territory for the first time since 2007, marking the end of the small landlord business. These buyers have historically formed the core of the buy-to-let market, with data from UK Finance showing that 73% of new buy-to-let mortgages since 2014 were taken out by people with a deposit of less than 30%. In the 2 years leading to July 2023, over 163,000 leveraged borrowers acquired £25 billion in new buy-to-let mortgages. However, none of these borrowers, if they were to take out the same loan today, would expect to generate a profit. Some landlords with lower mortgage payments or more money up front will still make profits. However, fewer new landlords will join the market. When the cheaper fixed-rate periods, often around 2 years for many landlords, end, they'll have to decide whether to sell their properties or operate at a loss. Small landlords have had a big impact on Britain's economy and society. Over the last 30 years, buy-to-let mortgages helped small investors turn a small amount of money into a valuable property, with tenants paying the costs. This simple, low-tax and profitable business became a way for many people to have a comfortable retirement. By 2021, almost 1 in every 5 people lived in a home they rented from a private landlord. The best part about buy-to-let property was that many people were doing it. And since not much housing, especially social housing, was being built, the house's value increased much more than inflation. However, things are changing now. According to UK Finance, buy-to-let landlords collectively owe £300 billion to British banks. This is a huge amount of debt to manage without any real benefit. In fact, the incentive now is to leave the market because ongoing high inflation is reducing the value of landlords' investments. Last week, Savills found that the real value of houses in the UK, adjusted for inflation, had dropped by 13.4% from its peak in March of 2022. October is usually a busy time for selling houses, and prices tend to go up. However, this year's increase in sales is barely noticeable, the weakest it's been since 2008, according to the latest Rightmove House Price Index. Many landlords will feel the need to sell their properties quickly, which will make prices drop even more. Some landlords might think that the housing crash, even if it gets worse, will only be temporary. But the only reason the market got better after the 2008 crash was that the Bank of England lowered interest rates almost to zero and put a lot of new money into the economy. But the bank is now working to reduce the amount of money in circulation, and its leader, Andrew Bailey, has repeatedly mentioned that interest rates will need to stay high for a long time. The battle against inflation is far from finished, and the housing market will continue to suffer. Swati Dhingra, one of Bailey's colleagues responsible for setting interest rates, told the BBC last week that only about 20 to 25% of the effects of rate increases have had an impact on the real economy so far. Housing is one of the first things affected because so many people rely on borrowing costs. But in the coming years, millions of people will reach the end of their fixed-rate mortgages and realize they can't afford their homes as easily. Even during economic recovery, prices may stay low if, for example, the Labour Party succeeds in building 1.5 million new homes in the next government term. However, house prices are influenced by more than just the number of houses available. Looking at the other side of this, to make housing more affordable, a slower market is generally a good thing. The problem is that many people have started relying on this idea as a replacement for their retirement savings and pensions. If this wealth disappears, it will affect more than just the property market. The time of lower house prices is just starting. What do you think of the UK housing market? Leave a comment below. If you enjoyed this video, like and subscribe for more valuable content.